Welcome back to Part B of Financial Planning and Budgeting lecture. Here, we will cover the rest of Learning Objective 3 and also Learning Objectives 4, 5, and 6. So, let us resume. We'll start here with the preparation of cash receipts budget. At Breakers, it says, all sales are on account. The company's collection pattern is 70% collected in the month of sale, 25% collected in the month following the sale, and 5% remains uncollected. So, how does a cash receipts budget look like? We will start with the accounts receivable from previous quarter. We are told here that the March 31st accounts receivable balance of $30,000 will be collected in full in the following month. And so the $30,000 will be collected first in April. What else will be collected in April? Well, we are told that the company's collection pattern is such that 70% will be collected in the month of sale. So we need to go back to the sales budget. In April, our expected sales revenue is $200,000. So 70% of that $200,000 is expected to be collected in the same month, April. What about the other 25%? It says 25% will be collected in the month following the sale. So 25% of the April sales of $200,000 will be collected in May. That means that in the month of April, we are expecting to collect a total cash of $170,000. In May, what else will be collected apart from the 25% from April sales? Well, in May, we are expecting to sell $500,000 worth. So 70% of that will be collected in the month of May. That is $350,000. So $400,000 is the total cash collection for May. What about in June? The 25% remaining from the May sales will be collected in June, plus 70% of June sales, which is $300,000. Therefore, $300,000 times 70%, $210,000. So we are expecting $335,000 in the month of June. The quarter column is simply the total of the 3 months. Let's move on to cash disbursement budget. We are told here that Breakers pay 40 per pound for its material. We have seen that in the direct materials budget, which I have reproduced up here. What else did they tell us? 1/2 of a month's purchases are paid for in the month of purchase, and the other half is paid in the following month. We are also told that there are no discounts available and that March 31st accounts payable balance is $12,000. So our cash disbursement budget should also start with the month of April, showing the accounts payable of the previous quarter, March 31st. What else need to be paid in April? Well, 50% of the month's purchases. So we go back to direct materials budget, and the material cost for the month of April is $56,000. So 50% of that $56,000 will be paid in April, and the other 50% will be paid in May. So our total expected cash disbursement for April is $40,000. For the month of May, we will consider the $88,600 May purchases, and 50% of that will be paid in May. The other 50% will be paid in June. So our expected total cash disbursement for May is $72,300. In the month of June, we also need to calculate 50% of $56,800, and that would be paid in the month of June. So total disbursements expected for June should be 72,700, and for the whole quarter, we'll just total up the total cash payments for each month. Once we have prepared the cash receipts and cash disbursement budget, we can now go to the preparation of cash budget, the collections and disbursements. Now, apart from the cash payments for the purchases, Breakers also told us that they maintain a 12% open line of credit for 75,000. So this is the LOC. They also maintain a minimum cash balance of 30,000, and they borrow and repay loans on the last day of the month. They also told us that they pay a cash dividend of 25,000 in April, purchases of 143,700 of equipment in May, and 48,300 in June, which will be paid in cash, and they have an April 1st cash balance of $40,000. So now we are ready to prepare the April cash budget. We'll start with the beginning cash balance. This is given at $40,000. Then we'll add the cash collections taken from the cash receipts budget of $170,000. That will give us a total cash available of $210,000. Then we'll go to the disbursements. For materials, this $40,000 came from our cash disbursements budget. The direct labor disbursement will come from the direct labor budget. It was $24,000 for April. Then from our overhead budget, the manufacturing overhead for April is $56,000. The selling and administrative expense of $70,000 is taken from our selling and administrative expense budget, and the equipment purchase will not happen until May and June, so there won't be anything in April. And of course, the dividends is as given here. We're going to pay that in April. So that gives us total disbursements of $215,000. Now, our cash available is only $210,000. So that means we are expecting a deficiency of $5,000 in the month of April. So what can we do? They do have a minimum cash balance of $30,000. That's the requirement of the company. So it looks like in April, Breakers will have to use their open line of credit and borrow $35,000 from there. Let's move on to the month of May. So for the month of May, we are going to do the same. We will have the ending cash balance from April, and that would go on to May. Now remember that the minimum cash balance is $30,000, right? So the beginning cash balance in May should be $30,000. Then we'll add the cash collections, $400,000, and we'll have $430,000 total cash available. Again, we'll get those information from materials, direct labor, manufacturing overhead, selling and admin expenses from those detailed budgets prepared earlier. And then we will also include here the equipment purchase for May amounting to $143,700. So it looks like the total disbursements for May is $413,800. So for the month of May, it looks like we have cash available over disbursements of $16,200. But remember that the minimum cash balance must be $30,000. So Breakers must still borrow $13,800 from their line of credit. Now for June, we'll do the same. So $30,000 again will be the beginning cash balance because that's the minimum. Then we add the collections, giving us $365,000. And again, we'll get all those figures from detailed budgets for materials, direct labor, manufacturing overhead, and selling and administrative expense. And we'll also have equipment purchase for June 48,300. So our total disbursements for June is 279,000, whilst our cash available is 365,000, giving us cash available over disbursements of $86,000. So in June, breakers will have enough cash to repay the 48,800 loan from the line of credit, including the interest of 12%. So for the quarter, you'll just add up those figures for the cash collections and the disbursements. So in this part, this is where you are actually calculating the financing that is required for each month whenever they don't have enough cash as required. Because remember that the requirement is to have 30,000 ending cash balance. So you can see from here that the 30,000 ending cash balance in April becomes the beginning cash balance in May, and also the same for June. Now, to calculate the interest, remember that the line of credit interest is 12%, but that is per annum. So if you divide 12% by 12 months, that means every month the interest rate is 1%. So for the month of April, when they have to borrow $35,000 at 1% interest, that would actually be multiplied by 2 months because they have borrowed it from April and also in May. Only at the end of June are they able to have enough cash. So 35,000 times 1% times 2 months equals $700. For the 13,800 that they borrowed in the month of May, they will multiply that by 1% and just for 1 month, they would have incurred $138 worth of interest for the month of May. So over April and May, the total interest expense is $838, and they have enough cash in June to pay for that anyway. All right. So for the quarter, the ending cash balance is the June ending balance, that is $36,362. All right. Let's now move on to the cost of goods manufactured. The cost of goods manufactured schedule is prepared from the direct materials budget, the direct labor budget, and the overhead budget. Notice the ending work in process inventory amounts are estimates provided by management. The amounts for direct materials are in dollars, not in units. Remember, the only detailed budget that is in units is the production budget. The direct materials beginning inventory, purchases, and ending inventory amounts were taken from the direct materials budget. These amounts were multiplied by the cost of 40 cents per pound to arrive at the dollar amount. The cost of goods sold schedule starts where the cost of goods manufactured left off. The cost of goods sold manufactured at the beginning of April can be divided by the units manufactured, 26,000 units, to arrive at a unit cost of $4.60. Now, the 4,000 units in finished goods inventory at the beginning of April is multiplied by the unit cost to determine the beginning inventory cost. The ending inventory for each month is also multiplied by $4.60 to determine the cost of the ending inventory. Remember, the ending inventory for 1 month becomes the beginning inventory for the following month. The beginning inventory for the quarter is the same as the beginning inventory for April, and the ending inventory for the quarter is the same as the ending inventory for June. So now that the cost of goods manufactured and the cost of goods sold schedules are complete, Breakers Inc. can now prepare the budgeted income statement for the quarter ending 30th of June. The revenue is taken from the, guess what, the sales budget. The cost of goods sold of $460,000 from cost of goods sold schedule will be deducted from the budgeted revenue of $1 million to reach the budgeted gross margin of $540,000. The operating expenses are taken from the selling and administrative expense budget as well as the cash budget. Net income is the gross margin less the total operating expenses. So when we deduct $260,838 from the gross margin of $540,000, we'll get the budgeted net income of $279,162. Let's now move to the budgeted statement of cash flows. Notice here that we are showing it in the same format of statement of cash flows. We have the operating activities, we have the investing activities, and we also have the financing activities. And where do we get the information for the budgeted statement of cash flows? These are all taken from the cash budget. Notice that our balance at the end of the quarter is $36,362, the ending balance in June. Now that we have prepared the budgeted statement of cash flows and the budgeted income statement, we are ready to prepare the budgeted balance sheet. Account balances for the property, plant, and equipment and the stockholders' equity accounts are needed before preparing the budgeted balance sheet. And so Breakers have provided this information from the balances on March 31st prior to preparing the budgeted financial statements for June 30th. So we've got land, building, common stock, and retained earnings balances provided here. So we can now prepare the budgeted balance sheet. We'll start with the current assets. Cash is taken from the cash budget. Remember that we had $36,362 balance in the cash budget. The accounts receivable is 25% of June sales. Recall that 25% of June sales would remain uncollected as at the end of June. We will find the raw materials inventory, the work in process inventory, and the finished goods inventory from the cost of goods manufactured and the cost of goods sold schedules. So once you've totaled that up, you can actually calculate that total current assets is $155,962. Recall that your raw materials cost 40 cents per pound and there were 11,500 pounds left in raw materials. The finished goods inventory cost $460 per unit and there were 5,000 units of finished goods left in the inventory. The land, as shown here, is $50,000 and building also is given at $148,000 net. The equipment can be taken from the cash disbursements budget or the budgeted statement of cash flows. You will find that we have $192,000 worth of purchased equipment. So the total property and equipment is $390,000, giving us the total assets of $545,962. Now the accounts payable is actually 50% of June purchases. Remember that we have $56,800 worth of purchases in June and we pay half in the month and the other half the following month. So we have 28,400 accounts payable. Then the common stock is as given here, 217,000, and then we calculate the retained earnings. The beginning balance of the retained earnings as shown here is 46,400. Then we'll add the net income from the budgeted income statement, which was $279,162, and we'll deduct the dividends paid in April, $25,000. So that would give us an ending balance for retained earnings of $300,562. So your total assets is equal to your total liabilities and equities, $545,962. All right, so that concludes Learning Objective 3. You can see that we have prepared a full master budget from the sales budget all the way to the budgeted financial statements, income statement, cash flows, and budgeted balance sheet. So now we are ready to go to Learning Objective 4. Here we will discuss the role of assumptions and predictions in budgeting. Managers must make assumptions and predictions in preparing budgets because organizations operate in a world of uncertainty, just like everyone else. One way to cope with that uncertainty is to supplement the budgeting process with a financial planning model. So what is this financial planning model? Well, a financial planning model is a set of mathematical relationships that express the interactions among the various operational, financial, and environmental events that determine the overall results of an organization's activities. So you can say that a financial planning model is really a set of mathematical expression of all the relationships expressed in the master budget flow chart. In a fully developed financial planning model, all of the key estimates and assumptions are expressed as general mathematical relationships. So the model is run on these key estimates, and so it's easier if you can change, for example, the sales forecast in a particular month and all the other detailed budgets, the production budget, the direct material budget, the direct labor budget, the overhead budgets will also be adjusted accordingly. So that is when we are actually using fully the financial planning model. So when the interactions of the elements of the master budget are expressed as a set of mathematical relations, then the master budget becomes a financial planning model that can be used to answer what-if questions about unknown variables. So, for example, if I say, what if sales is 50% lower than predicted in the month of April? What will be the effect on direct materials, direct labor, overhead, and what would be the ultimate impact on the profit? You could also ask, for example, if you can see that the economy is booming, you can actually predict what would be the impact on profit if there is a 30% increase in the volume of sales in May, for example. And so you are able to easily manipulate the figures that you have, and you can easily see what is the impact on the profit if there are certain variables that change. What if the cost of the materials change from 40 cents to 50 cents per pound? You can see how it will impact the profit. And that is the reason why financial planning and analysis system is very useful for profit as well as operational control. All right, let us move on to the next learning objective, and this is where we'll describe a typical organization's process of budget administration. Let's talk about budget administration. In small organizations, the procedures used to gather information and construct a master budget are usually informal. In contrast, a large organization would have a formal process to collect the data and prepare the master budget. Such organizations usually designate a budget director or a chief budget officer, which is often the financial controller of the company. A budget committee consisting of the key senior executives often is appointed to advise the budget director during the preparation of the budget. This committee is responsible for policy matters relating to the budget and coordinating the preparation of the budget. The authority to give final approval to the master budget usually belongs to the board of directors of the company. By exercising its authority to make changes in the budget and to grant the final approval, the board of directors can have considerable influence on the overall direction of the organization. Now, e-budgeting is an increasingly popular internet-based budgeting tool that can help streamline and speed up an organization's budgeting process. The E in e-budgeting stands for both electronic and enterprise-wide. In e-budgeting, the employees throughout the organization at all levels and around the globe, if the company is a multinational company, so the employees can submit and retrieve budget information electronically via the internet. Remember, one of the purposes of budgeting system is to communicate and coordinate. So e-budgeting is a good way to be able to coordinate the preparation and the dissemination of information in the budget. The managers in organizations using e-budgeting have found that it greatly streamlines the entire budgeting process. In the past, these organizations have compiled their master budgets on hundreds of spreadsheets which had to be collected and integrated by the corporate controller's office. So they are able to really streamline the process. Now, firms with international operations face a variety of additional challenges in preparing their budgets. First, a multinational firm's budget must reflect the translation of foreign currencies into US dollars, for example. Since almost all the world's currencies fluctuate in their values relative to the dollar, this makes budgeting for those translations difficult. Although multinationals have sophisticated financial ways of hedging against such currency fluctuations, the budgeting task is still more challenging. Second, it is difficult to prepare budgets when inflation is high or unpredictable. While the United States has experienced periods of high inflation, some foreign countries have experienced hyperinflation, sometimes with annual inflation rates well over 100%. So predicting such high inflation rates is difficult and further complicates a multinational's budgeting process. Now, finally, the economies of all countries fluctuate in terms of consumer demand, the availability of skilled labor, the laws affecting commerce, and so forth and so on. So companies with offshore operations face the task of anticipating such changing conditions in their budgeting process. And that complicates the budgeting process a lot more, as you can imagine. Now we have come to the last learning objective, and this is to discuss the behavioral issues in budgeting. So, how do budgets affect the behavior of the employees and the managers for that matter? There are two terms that I'd like to introduce to you: budgetary slack and padding the budget. When a supervisor provides a departmental cost projection for budgetary purposes, there is an incentive to overestimate cost or underestimate the revenue. When the actual cost, for example, incurred in the department proves to be less than the inflated cost projection, then the supervisor appears to have managed in a cost-effective way. Well, at least that is the perception of many managers. And in behavioral area, perceptions are what count most. These illustrations are examples of padding the budget. So budget padding means underestimating revenues or overestimating costs. Now, the difference between the revenue or cost projection that a person provides and a realistic estimate of the revenue or cost is called the budgetary slack. Most people will perform better and make greater attempts to achieve a goal if they have been consulted in setting those goals in the first place. So the idea of participative budgeting is to involve employees throughout an organization in the budgetary process. Such participation can give employees the feeling that, hey, this is our budget. We are involved in setting these goals, rather than the all too common feeling that this is the budget you imposed on us. So whilst participative budgeting can be very effective, it also can have some disadvantages or shortcomings. Well, too much participation and discussion can lead to uncertainty and undue delay in the budgeting process. Also, when those involved in the budgeting process disagree in significant and irreconcilable ways, the process of participation can accentuate those differences. Finally, there is the problem of budget padding when you are asking the supervisors to filter through their middle management and to the top management what it is that they think are achievable. So that is obviously a disadvantage of participative budgeting in a sense. But overall, if you can manage somewhat a balance between participative budgeting and looking out for this budgetary slack, then you're able to actually make the budget more acceptable to the employees, because when the employees are consulted, they feel empowered and therefore they will be more likely to accept the budget as their own. All right, well, this is it for financial planning and budgeting. I'd like to end with this verse from Proverbs chapter 19, verse 21. It says, "Many are the plans in a person's heart, but it is the Lord's purpose that prevails." This quote from Louis Giglio is also well suited for our topic today. It says, "God's plans for your life far exceed the circumstances of your day." Let us close with a word of prayer. Our gracious Father in heaven, thank you so much that we have come to the end of this lecture presentation. Father, we pray that as we continue on with the rest of the activities for this topic, that each and every one of us will be able to learn how to apply this financial planning system and the budgeting system. And we pray that it's not only in the planning for the company that we can apply this knowledge, but also in our own personal life, and help us to always include you and to always put you first in our plans. Help us to commit our plans to you so that you can guide us, because we know that you want what is best for us. We ask this in Jesus' name. Amen. All right, well, this is it for our lecture. Don't forget to do your post-lecture required activities, and I will see you in class shortly. Bye for now.